Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 24th of April. I'm Daniel Lam, your host for the podcast. Today, I would like to switch gear and talk about the recent resilience in Chinese equities. This is something that we also touched upon in our three-part series of podcasts last week. We highlighted in the series that Chinese equities have been steady over the last 2 months, despite the lack of foreign inflow, compared to past episodes of stabilisation or recovery. Now, positioning is certainly not a headwind against Chinese equities, and bears risk capitulating if macro momentum continues to improve gradually relative to expectations. Now, the last line is very important because investors are often very fixated by their own perception, i.e., what is bad is bad. But risky assets are actually about how data stack up versus expectations, and Chinese data is running up against some low expectations, both on macro and on the company's front. Now, allow me to highlight some of the findings in our Standard Chartered Small and Medium Enterprises Index in China, the SMEI. Now, this edged up to an 11th-month high of 52 in April versus 51.6 in March. So the performance sub-index rose another 1.2 points to 52.2 in April, as the sales, new orders, and profitability sub-indices pick up further. So this shows a stable outlook and financing conditions for SMEs. Now, the manufacturing SME performance sub-index rose nearly 2 points to 55.5 in April, supported by a further month-on-month increase in sales, production, new orders, investment, and profitability. And the survey suggests that the momentum continued after a seasonal rebound in March after holidays. Activities at real estate and finance SMEs declined for another month, but other services SME performance rose further. So overall, this is not an all-clear picture, but it does go and validate that Chinese assets are not looking so bad. Indeed, we've seen some broadening out of performances. So starting off from the non-financials, high dividend yielding SOEs that we've been highlighting, to more specific areas like technology hardware, and then the internet stocks. The Hang Seng Index held its support at 16,000, and it is not a bad idea to accumulate some Chinese equities towards that support level, especially for the longer-term investors. The mild volatility we're seeing in US equities may also help in terms of fund rotation into these relatively cheaper Chinese equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.